Welcome to episode 27 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's interview is with Stenning Schueppert of Evolution Strategy Partners. Nicholas, what did you think of our conversation with Stenning?
Stenning is an amazing guy, and one line he gave us in the pre-call, but it didn't actually come up in the actual interview, stuck with me. He said that closing a deal is the worst word. It should be called opening. And what he meant by that, of course, is that that's when the real work starts if you're a hands-on, operationally focused independent sponsor. And so there is so much truth to that. So I'm now second guessing the word closing every time I use it. Another topic that we discussed in the interview was the usage of an advisory board. And everyone has boards for their portfolio companies, but Stenning actually has an informal group that serves as a advisory board for him at the Evolution Strategy level. And so he interacts with them on a weekly basis. He shared some of the emails that he would send them every week, and these were extremely detailed. And so for him, it becomes an accountability partner, someone with whom he can share on a weekly basis what's going on with this or that employee, this or that legal dispute, this or that add-on LOI conversation, whatever it is it's something for him to report. And as we all know, once you start reporting things, you really start to also pay attention to it. And so it becomes a really good thought partner and accountability partner. And I thought it was a little bit of a paradox because of all the independent sponsors out there, Stenning is one of those who probably needs the least advice. He's very accomplished, very experienced, but nonetheless, he is the one out there advocating the use of an advisory board.
Great. Max, what did you think of Stenning Schueppert?
Well, I thought it was a great podcast. Stenning is definitely seasoned, and he's got a great track record. I think he mentioned his collective portfolio is sitting at about 10x MOIC. So that's impressive enough on its own without saying much more. But he really highlights one of the best attributes, I think, of the independent sponsor model, and that is the ability to be very patient. He talks about traditional private equity and the J curve that incentivizes a traditional fund to make investments quickly and to sometimes pay a bit more in terms of valuation. The independent sponsor model, obviously Stenning and Evolve Capital Partners, they're not sitting on committed capital. There's no pressure to deploy that capital. So they can be more patient. They can sit back and wait for a more favorable valuation, which he's done again and again. And I think that's, as he says, a very big part of why their portfolios have been so successful and why they're sitting at a collective 10x MOIC. So it's that basically, the ability to be patient, the ability to then capitalize on a more favorable valuation. That sort of sets apart the independent sponsor model from the private equity model. And, he mentions there are so many deals that are a good fit for the independent sponsor model, just in terms of deal count and deal size versus bigger private equity funds. They're all chasing bigger deals. There's far fewer of them. That's another factor of why that market tends to get bid up a bit more. So everything he said about valuation and about the ability to be patient just makes me more excited about investing in this space and the ability to have a portfolio in this space of different investments. Really seems like a winning strategy.
Yeah, we spend a little bit of time on the contrast between independent sponsorship and traditional private equity, fund-based private equity. And he talks about one of the things that he so likes about independent sponsorship is it allows an alignment between him and his LPs that you don't have in fund-based traditional private equity. Specifically, what that means in his case is he has a lot of skin in the game in all of his deals. It's something that he talks about a lot, the back pocket dollars that he puts in. And I guess probably my overall takeaway from our conversation with Stenning, that really just kind of the impression that it left was how engaged he is. He's, as you'll see stylistically, he's has strong opinions, many of them. He's very dynamic and fun to listen to, but he's also very communicative with his LPs. He's regularly updating his LPs. He's very active in his portcos, not only financially with all that skin in the game, but he's because he's got so much skin in the game, all that the alignment I mentioned. He's just very, very involved with them. You come away with a sense of a just very passionate, if I could use the word, independent sponsor, both with respect to his LPs and with respect to his portcos. A really invested, and I mean that in every way, independent sponsor. So really an enjoyable interview for me, and he left quite an impression. Before we turn to the interview with Stenning after that teaser, time to announce a new partnership that we have with a data provider in our space, GF Data. Two components to this new partnership. First is GF Data is going to be sharing their quarterly reports with us ahead of their publication. So we'll get some of that scoops on some of this data. We're about to share some of that with you. And secondly, exclusively for Minds Capital audience listeners, if you are an independent sponsor, you can access the GF data set for 3 months for no cost if you submit data from one of your own deals. So this is an exclusive offer. Submit the data from one of your own deals and get access to GF Data's data set, proprietary data set, some of the best in the industry for 3 months. And so you won't find that offer anywhere else. It's something that we worked with them to really iron out, and we're really excited to announce it here. Going back to the data itself that they're going to be sharing with us in advance of publication, Nicholas, I think you were going to call out a few of the findings.
Yeah, we were just reading it together here, and a couple of things. We were looking on the tab called leverage, and there were two things that I noted on that tab. One is that the cost of senior debt has come down quite a bit since it peaked in mid-2023. So if you look back in the pre-inflation area, senior debt for lower middle market and middle market deals would hover between 5 and 6%. It skyrocketed up to 10.5%, peaking in 2023. But since then, interestingly, it's come down to now 8%. So for everyone structuring deals out there, that's something to keep in mind. Now the line for sub-debt, and I suspect a lot of mezz lenders and SBICs would categorize themselves as that, even if they do the whole debt stack, that has stayed pretty flat over time between 11 and 12%. So interesting evolution there on the cost of senior debt in particular. The other point I see here is the breakdown of rollover equity. And within our portfolio, we've seen that roughly one turn or roughly 0.8 x EBITDA of an average deal that we invest in comes from rollover equity. And this data actually jives very well with what GF Data is presenting. In their data, an average deal has about 15-16% of the sources and uses comes from rollover equity. And so where I thought that was a little bit unique within our portfolio, I now understand this is actually a feature of the lower middle market that you really want the seller to stay engaged, and you also need it as part of your financing to make it all go up.
Great call outs. Thank you for that, Nicholas. And we will have a link to the landing page for the offer that I mentioned earlier. If you're a sponsor who can share information on one of your deals to access the 3-month offer from GF Data, the landing page for that, the registration page for that is linked to in the show notes. So look for it there to take advantage. Also, a reminder from us, the partners at Minds Capital, that we are actively investing in independent sponsor deals. So if you're a sponsor raising for your acquisition, submit your deal to us, deal@mindscapital.co. And if you're interested in investing as an LP in Minds Capital, to be kept in the loop on our future raises, one of which is imminent, there's a pre-registration form on our website for accredited investors. That's mindscapital.co. And with that, here is episode 27 of the Minds Capital podcast with Stenning Schueppert of Evolution Strategy Partners. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Stenning Schueppert of Evolution Strategy Partners has been in private equity since the 90s, and today is a prolific independent sponsor headquartered in Austin. The Evolution portfolio consists of 5 platforms, currently marked up at more than 10x cash-on-cash returns. Ethoscapes, their landscaping platform, sits at over 17x MOIC and has won multiple deal awards. Stenning suggests that significant personal capital commitments, an advisory board at the holdco level, and hard work in the operations at the portco level distinguishes Evolution. Stenning, welcome to the Minds Capital Podcast.
Pleasure to be here. Thank you.
First question for you, Stenning. What is more incredible? Your marked up returns or the fact that you actually mark up your investments, which isn't something that we see many independent sponsors actually do?
I think the only thing incredible about that, Will, is the lack of transparency that other people choose to go down that path. The first part is simple math. I think when you do good deals at low valuations with a limited amount of debt, the cash that you generate pays down that debt relatively quickly. You don't have so much debt, so you're not having all your cash service debt and or interest, and you can generate cash-on-cash returns that are compelling to the investors. The second part is just a question, in my opinion, of transparency. I spent 20 years in traditional private equity. I would not call traditional private equity and transparency synonyms. But in the independent sponsor world, if you're in the business for yourself and you can bet on yourself, why not be transparent? So we have very simple math and markups to say, hey, here's what we're doing and here's how we're performing for our existing investors. And as I first met you guys through a trade show / conference, happy to share those with prospective investors as well to say, this is what I'm doing, this is how I'm doing it. And here is one simple math formula to say how the performance of the portfolio is coming along.
Do you think, Stenning, that other independent sponsors aren't similarly transparent because they come from traditional private equity where, as you said, transparency and private equity are not synonyms?
Traditional private equity does have its challenges. I love the independent sponsor model, and I will not go back to the traditional private equity model for reasons we can discuss. I love the alignment between the GP and the LP with the independent sponsors. But I think on a transparency point, it's a simple choice. I think I'm at the point in my career where I've seen the games played over 20 years with traditional private equity firms, however they may be, and I just choose not to do that anymore. So I think every independent sponsor could be transparent, and if he or she isn't, as an investor, you could say, well, tell me how you're coming up with your markup. Tell me how the last deal is doing. Tell me how your portfolio is doing. It's a simple question, and if they're not willing to answer, you should have other questions.
I've heard you say a few times the way you do your markups and how simple the equation really is. Tell us what that is, because it takes all of 3 seconds.
We take our original purchase price multiple. We apply that to current EBITDA. We subtract out debt. In debt, we include any seller notes, earnouts, and or management options. Then you're left with an equity number. You divide equity by number of shares.
Yep, great.
Simple. We don't apply a market multiple arbitrage. We don't assume growth. We don't do any of that. We literally take our entry multiple and assume we'll get the same on exit. We hope we don't, but you got to leave icing on the cake.
So transparency and conservatism.
Yep, absolutely.
And so what's different here is that when you go to conferences, you have a one-pager and you literally list the markup for each of your portfolio companies and hand it out to prospective investors and whoever wants to see your one-pager. So you're very public about it. Mm-hmm. Were you always advertising your markups, or is it something that you can afford to do now because the portfolio is performing so well?
There's probably a little bit of a selection bias there, Nicholas. I think that's a good point. I think if you had a bunch of stuff below 1, you might not necessarily want to market that. But for those investors that ask for a full track record going back to the beginning of time, there's a couple in my past that I worked on that are there that are not quite so stellar. But it's very kind of Janet Jackson. What have you done for me lately? As an independent sponsor, when you control the investment and you control how you're treating your portfolio companies, your lenders, your investors, I think it's a totally different world than a traditional private equity fund. So as applicable as a track record may be as a private equity person, the independent sponsor model and role, I think, is so different that's the track record that people should focus on, because that's how you're not only behaving now, but you want to behave and model the future. So is it a selection bias? Possibly. But like I said, it's just a better way to do business. And, when we can control our destiny, why not control how we treat others?
Stenning, when we talked to you in the pre-call, you talked about the word alignment as being one of your favorite features of the independent sponsor model. And we joke, and we've now heard you say it here, but we joked that usually it's the word flexibility that we hear independent sponsors celebrate. But for you, it was alignment. You said it a minute ago. Talk to us more about this belief of yours.
Yeah. So, look, a traditional private equity fund, the GP is proud when they say, we have a commitment and we're aligned with management and we're aligned with our investors. And most of those private equity funds, not all, certainly someone's going to, put in the context or the comments that, well, we do 5% or whatever. Well, congrats. Most private equity firms are happy when they say they have a 1% co-invest. Taking a 1% co-invest after a 2% fee is an alignment. That's buying yourself a job. When you have literally less than zero invested in a deal, that's not alignment. Evolution between myself personally and my colleagues that I work with, and if you want to combine friends and family within that, we're typically 30 to 50% of the cap stack. So we are materially different. You behave radically differently when you own a large portion of the business before economics. Okay, I'm taking economics out of it. I'm talking about back pocket dollars. Real hard dollar commitments where personally myself and my colleagues are, at least 20, like I said, up to 50% of the cap stack. That's alignment. When I go to a meeting or when I plan a hotel, we fly Southwest, we stay at Holiday Inns and Best Westerns. I drive used cars. That's alignment. You don't want your sponsor or your private equity firm, having the nicest steak dinners and flying first class and getting the black private limo. That's cash coming out of the investor's pocket. When that cash is 20 cents, 30 cents, 50 cents, mine and my team's, you behave differently. As a result, you focused on cash returns. You don't necessarily focus on fees. You don't necessarily focus on, increasing management fees, or I care about an option value for carry at some point in the future. You care on true cash returns. And at the end of the day, that's all the investor cares about. Some mix of cash on cash returns as well as IRR. But at the end of the day, if I'm making more money with my cash on cash investment than I am off of promote for my investors, that's the definition of alignment. I am better off economically making my own return, ignoring any promote or carry, whatever you want to call it, from my investors. As a result, my investors know I have their best interest at heart, because so much of that dollar, that profit, is mine anyway.
Walk us through the math there on how you make more money on your invested capital than you do on the carried interest.
Really simply put, again, we'll keep it simple, Nicholas. If I own really simply 20% of the economics myself, by definition, your carry is 20, maybe 25% upon a high hurdle, but let's just simplify for the sake of discussion, 20%. 20% of 80 is 16. So 20% I own, 16% economics, 20 is more than 16. I'm better off and I'm more invested in the cash on cash return than I am on the promote.
If you have that amount of personal capital to put into the deals, wouldn't you be tempted to chase larger deals in order to get more AUM and make that carried interest bigger because you are managing more money?
That is, Nicholas, it is a constant struggle. I can do math like everyone else. higher AUM and bigger carry dollars. That's the traditional fund game. I totally get it. But Nicholas, I hate to say I'm sacrificing personal wealth for fun, but I kind of am. I think at the end of the day, I was at the traditional private equity firms, as we discussed, for many, many years, and I saw that path. I genuinely enjoy what I do now. I genuinely enjoy the people I do it with and the people I do it for. And is there a quote unquote sacrifice on economics? Possibly. But at the end of the day, a larger carry on a smaller return probably gets me back to where I am anyway. I'd rather have a smaller carry because my returns from my team and my management teams and our investments are going to be strong enough. I think I kind of get back to the same point anyway. Admittedly, right, if it was $1 billion versus 50 million, that's different math. But at the end of the day, if you genuinely enjoy what you're doing, I think, the returns follow. It's some alignment, but economic health is only part of your whole wellness, and you need a personal health and a mental health and a spiritual health. And I can tell you, I don't want to necessarily move the conversation here, but I can tell you, for many, many years, so many of my colleagues, and admittedly myself for a number of years, was chasing one part of that, which was kind of economic success, and sacrificing everything else. And I'm proud to say where I am now, I think you don't have to sacrifice economic success, but you can balance it with, mental, spiritual, and physical well-being.
Let me invert the argument. So you just made the case for why you don't want to do bigger deals. But if you have significant personal capital, why don't you do smaller deals where you can do 100% of the capital and you can truly control your own destiny in the whole period?
There is some economies to scale, Nicholas, to be blunt, right? If I go further south, there's some economies to scale where it's hard to do deals. And unfortunately for the independent sponsor model, some of the economics scale economies, if you will, are inverse, right? It's just as difficult to do a Q of E and proper legal and all of the stuff you need to do to close a deal for a $3 million EBITDA business as a $10 million EBITDA business. So going smaller than that, Nicholas, gets harder and almost diseconomies of scale start to take over. The other part of it is we are truly invested in our businesses and we feel like we can have an impact that's going to have a material enough difference on the business. Smaller businesses, Nicholas, I think get to greater kind of personalities and greater concentration of risk. So for me, there's a happy medium there. We generally stay above 3 million of EBITDA. South of that is tough for platforms. For tuck-ins, certainly. But in a way, actually, the experience we have with tuck-ins and smaller than 3 of EBITDA validate the need to have a platform, because if they were independent, the drama and or the challenges you have with some of the tuck-ins just wouldn't be worth it if it was the entire investment.
So it sounds like you're very committed to the lower middle market, 3 to 5 million EBITDA platforms. And over time, you would imagine that your personal balance sheet only gets better. So presumably your percentage of these deals will continue to rise.
To some degree, we either do a couple more, or to keep it interesting to my colleagues, I would limit my personal investment in there, or ultimately start giving them economics if I were to be a greater portion than we are. Because you need to give incentive to my colleagues, Ken and Sean and my other investors. You need a balance there, right? They're not going to work as hard as they work if they don't have any skin in the game and or upside themselves. So there's a balance there.
Right, because they only earn carry on the external investors and not on your portion of the cap table.
Exactly.
Going back to your portfolio, you have 5 portfolio companies. I believe one just closed here very recently, mm-hmm. But of the other 4, I think Will said in the intro that the aggregate cash on cash markup right now is hovering at 10 or more. Could you walk us through that?
Sure. We did a platform deal in 2020. That's the landscaping deal. We raised capital most recently at right about $17 a share. We were taking that to market, but with the recent headwinds that you have with labor and labor pools here in the United States, that headline risk needs to go away before both our landscaping deal, as well as others actually in the industry, I obviously won't use names, but a number of landscaping deals and or other deals that probably have that, what I'll call headline labor risk, go away. We'll take that back to market when that risk has, in my very strong opinion, been abated, because it is not a risk to that business or other businesses like it. So much so in the last 9 months, we've lost about 1% of our employee workforce at our landscaping company. So not a risk. And quite frankly, that's less than typical turnover. In 2021, we did a construction deal here in town. We actually just provided liquidity to all the investors that were looking for some liquidity on that. We paid off 100% of our debt in just under 3.5 years. That allowed us to do a share tender for our investors looking for liquidity, and that was in the $8+ a share gross number. And then our 2022 deal, another construction deal up in Michigan, we're sitting at about a 6x on that. Again, Will or Nicholas, I forgot who asked the question, I apologize. Very simple math. EBITDA times our entry multiple minus debt divided by share price, or divided by share count. That's it. And then our electrical contractor, we did just over a year ago. We haven't marked that anywhere because we're just over a year on that. We don't mark anything in the first year. There's always a little hard work to get everything off on the right track. And then, as you mentioned, Nicholas, our 5th deal we closed just about 2 months ago. So clearly no change there.
So you start each share price and each portfolio company at $1 a share. Mm-hmm. Incredible results so far. Must be very encouraging and exciting. What are some common threads that you see across these success stories?
I think transparency, we talked about a little bit. Honesty and respect. I have a great deal of respect for not only the owner entrepreneurs that we bought and or still own the businesses with. I think one of the issues that I had over my career, private equity folks in general tend to think they're the smartest people in the room. And I can promise you that's generally not the case, especially with owner entrepreneurs that have made this country amazing, who have built businesses from either nothing or from scratch. And they're the ones putting tens of millions of dollars in their pocket. And we're just happy to invest in those businesses. So I think the level of respect I have for both my sellers, my rollover entities, but more so going forward, the management teams that are going to continue to run the business and continue to be in place, as well as the guys out there making it happen. Every board dinner I have, and I say it sincerely, every board dinner I have, I always toast the crews out in the field because they're the ones actually paying for this dinner. They're the ones that make this possible. The crews out in the field, be it landscaping, construction, contractors, whatever, AKA the Evolution portfolio. I have respect for those guys. I have respect for the teams that are in place. And that manifests itself in having teams, I think, ultimately work harder with you because they want to succeed. Some of that respect economically is easy to see because we have option plans for all of those shareholders and those management team members. They will also kind of want to understand, hey, what does this mean for me? So many of these people, it's their first equity ever. So many of these people don't know mergers and acquisitions, obviously, but don't understand those options. But when you say, look, this isn't liquid today, but your options today are probably worth X. And for most of these managers, that's a real number. It's a material number to them that they've never imagined before, in addition to obviously their hard work and salaries and bonuses, et cetera. But respecting the team, I think, is one. Perspective is another. Not every day is a great day. Not every chart is up and to the right. Not every, conversation is easy and happy. But having perspective that, this is a marathon, not a sprint. We are ultimately in the leverage buyout business. We do need to make returns for our shareholders, but there's a way to do that honestly and with integrity rather than, let's just say, the other way.
Can I play a little devil's advocate here?
Absolutely.
And I wouldn't do this with anyone, but you're quick on your feet and have a very substantive strategy behind this. It's easy for the thousands of private equity guys out there to say they are founder friendly or act with integrity or have respect and perspective. And I believe you 100% when you say you do have this, but the results that you're presenting are very differentiated. This verbiage you're presenting is not, however, that differentiated. So if we peel the onion on evolution, you've had a long career in private equity. What is it truly that, separates men from boys here?
I think patience, Nicholas. I think the J curve in traditional private equity gives folks an improper need to put capital to work. And when it's not their own capital and they have a J curve, they're going to go do deals and put capital to work at whatever price makes sense. And investors and LPs in traditional private equity don't want to hear that you didn't do any deals this year. They want to say, what deals have you done and have you put my money to work? And as a result, there's pressure to do something. I don't have that pressure. Evolution has never had that pressure. By definition, independent sponsors don't have a J curve. You technically do on a deal-by-deal basis because you have to make up for your transaction fees and expenses and your dilution from a management option pool. But other than that, right, you don't have money burning a hole in your pocket on a fund level basis. So we are patient. We will stay. Some people would call it cheap. Some people would call it frugal. I would prefer a nicer word that probably means the same thing, disciplined. We're happy to look at a bunch of deals, kiss a lot of frogs. And if people think their business is worth 2-3 times more than we do, God bless. Someone out there is going to buy it. And I'm obviously not going to use any names, but we've looked at deals that we think are squarely worth 4 times, and that's a gift. And someone comes in and offers 6-7 times. That 6-7 times is very rarely, if ever, and again, I'd have to go through records and to make a statement like that, but very rarely another independent sponsor. It's a strategic, it's a financial, it's a bigger fund, whatever. And it's going to be the same company as a contractor that we invested in 2021 or 2022. But their returns are going to be markedly different because they're putting in twice as much cash as I am into that deal on an equity basis. Our structure with respect to our target companies is pretty boilerplate. We're looking at 2.5 times cash, maybe a turn of a seller note, half a turn or a turn of earnout, and 10, 20, 25% rollover. So you can get to an enterprise value that's 4.5, 5, generally probably call it 4.5 times, maybe with rollover, on a levered equity basis, you're at a 5 times total enterprise value. That prices you out of a lot of deals. But really simply put, if I'm putting, a turn of equity and cash into a deal because I've got a limited amount of senior debt, and then I'm ultimately, we all know exactly what I'm doing. We're getting seller financing for a turn and a half or more of that because an earnout, which we expect to earn, is 0% debt from the seller. And obviously the seller note is junior subordinated debt at 6 to 8%. But as a result, you're putting 1 turn of equity into the deal. That's how you get cash on cash returns. You don't get high cash on cash returns by buying something at 8 times and putting 4 times equity into it. You're hoping maybe that you get some multiple arbitrage out of that, but when you're levered at 4 or 5 times, all your cash flow is getting consumed by interest. You can't generate cash on cash returns until you exit.
Is that the break point, do you think, on senior debt, that if you go up to 4x plus with current interest rates that you don't have any spare working capital to grow?
Oh, Nicholas, I use that as an example of other firms. Our deals are squarely 1.5 times levered. We're modeling 1.5, maybe 2 times senior leverage total.
So if we are underwriting a deal that has 3 or maybe 4 times EBITDA in debt, that, if you do the math, means there's no cash left for growing the business or for a rainy day fund.
I mean, I don't want to shame anyone buying 8 times businesses and using 4 times leverage by any stretch, but you'd have to look at CapEx and or the consumption of net working capital. Is the business growing and consuming net working capital, or is it flat? Net working capital should be flat at that point, but CapEx is a real number. I've never understood, as an example, and I'll use this because I don't know anyone personally invested in it, but like the trucking businesses and the transportation businesses that trade for 8 times EBITDA. When they're trucks and there's maintenance and there's massive CapEx every year on a free cash flow basis, you're in the double digits. I don't understand it. I can't do the math. But ultimately, when you're the large private equity firms, you can write checks like that because their underwriting case is a 2 or a 3x because they're writing $100 or $200 million check. And right, they're getting carry on $100 or $200 million check, and I understand it works for them. But if I'm an investor, I'd much rather say, okay, there's a little more variability in the lower middle market, but the returns are just markedly different. But we all know the reason why the big endowments can't come to the independent sponsor in the lower middle market is because they don't want to be bothered writing $5-6 million checks, right? They'd have to write 20 evolution checks to equal one Warburg Pincus check. It's just
when you say there is more variability in the lower middle market, you mean outcomes, right? Compared to middle market and large cap deals. Do you have any anecdotal kind of sense for what the difference is?
Anecdotally, obviously, I apologize, I'm not prepared to quote the studies, but I know when I was in traditional private equity, fund ones generally outperform funds 2, 3, and 4. Anecdotally, I also know that independent sponsors as an industry return higher than private equity. But there's greater alpha, right? There's certainly some independent sponsors that, take 5 million and run it to zero. I think there's fewer institutional investors that write 200 million and take it to zero.
Right.
So I think there's greater alpha. It's on a much smaller number, obviously. But I think the returns on independent sponsors are probably, the bell curve probably hits zero and hits, a 10x. Whereas I think institutionally, your bell curve probably hits a 0.5 to a 4. There's just the bell curve, I think, is just much tighter. And I've seen reports, but I can't quote them off live. Over the years.
But it resonates with your real life experience that on average, there's more volatility, but the returns are higher. So it's a riskier, and that fits perfectly on a risk reward curve, right? I mean, it's a riskier asset, but it's also a higher reward. And so if you do a portfolio and if you do it often enough, that will benefit you in the long term.
And I've seen it personally, and I don't think, we'd be allowed to use their name, but the original name of that firm used to be called the Harvard Investment Group, and now they use an acronym. But when that firm was smaller and when I was there, we were writing smaller checks, the returns were higher, right? That firm's returns were fantastic, and it was a great training ground, and I have nothing to take away from that firm or the people at that firm. But as they've moved into asset managers, the returns have confirmed the median. I don't think that's a question of skill set by any stretch. I think that's just a question of math. It's more competitive in the larger market. You are less, your J curve is greater. You have more pressure to write massive checks. And there's only so many companies that can write massive checks. The independent sponsor world, I mean, guys, we submit probably an LOI a week. I mean, you can't do that in the large fund basis. There's not that many deals out there. And by the way, we're looking at probably 2%, if not less, of the deal flow out there. I mean, this country is made up of tiny lower middle market businesses. There's almost an infinite, and I know not mathematically, but let's just for argument's sake, almost an infinite number of deals the lower middle market and or the independent sponsor can do. As a result, you're going to be able to find deals that fit your profile, fit your desire, and fit ultimately your budget. The larger funds can't do that. There's only so many deals. And by the way, they're passing them to and from each other because they've run out of new deals to do. It's like Hollywood. It's they're coming out with the same movie over and over and over again.
Stenning, you mentioned buying at a good price. You're structuring. What about operational involvement? Is that at all a part of your formula for success? Because we got the impression from your pre-call that you're much more involved as a sponsor than many others.
Well, let me only correct you slightly, Will. I'm much more involved than I was as a private equity guy. I don't know that I'm more involved than other independent sponsors. I want to make that clear.
Okay. Right.
So I only have personal knowledge on that. And that involvement is much greater. We formally talk to our portfolio companies every week. We have structured calls every single week. Obviously, board meetings on a quarterly basis, et cetera. But on a daily basis, hours and hours and hours a day of whatever is the topic du jour in now any one of what now is 5, but was 4, and obviously 3, 2, 1, going back the years, events of the day. With our landscaping business, we've done 5 tuck-in acquisitions. That's, with respect to the team, that's almost exclusively been on Evolution shoulders. That's a lot of deal flow and a lot of deals to handle and process, negotiate, et cetera. We get involved in the typical stuff that is not running the business, but where we believe we can add value. And genuinely, going back to the respect part, the respect of the management teams that want some of their stuff either off their plate, or they want help with, or they want someone in the room to bounce ideas off of. And that's going to be skill sets and or Rolodexes that are consistent across any portfolio. So I don't think I'm unique in that matter, except I've developed that trust and respect where they will call me and say, hey, can you help on this? Or on every call, I either begin and or end every one of our calls with, how can we help you? What else can we do to help you? And it's a genuine ask. And it takes a while for the management teams to say, actually, we could, use your help here. Or some cases, just a couple weeks ago, we sent one of my Evolution team members, Sean. We sent him on site at a portfolio company for 2 weeks to do literally whatever was necessary. That kind of help you don't generally, or at least I didn't see in traditional private equity funds. But we help with recruiting, with HR, with legal, tax, audit, accounting, social media, LinkedIn, websites, brand redevelopment and logo refreshes, all the stuff that you don't want me bidding a job. You don't want me running an excavator, as fun as that would be. I don't want to be behind $1 million machine actually running a job. But we can obviously help on stuff that they don't run across every day. Be that on the downside with legal issues, legal troubles, and or lawsuits. Be that with either upside or downside with headhunters and recruiting and either hiring or replacing folks. Or be that on the more creative side with social media and websites and branding, all that stuff. A couple of our portfolio companies, because they're smaller and because they know what they know, literally didn't have websites and LinkedIn. So just bringing some of that, I won't even call it sophistication, but just bringing some of that rather basic know-how to our portfolio companies is how we can add some value to the lower middle market. These, going back to the bigger deals and all that stuff, they've already got teams that do that. So I kind of question, well, what is the private equity firm doing to truly add value when they have, full rosters of FTEs and other experts already doing all of that? We're supplementing that for our companies.
Great, Stenning. Let's pivot a little bit to partnership.
Yeah.
You have had some experiences there that were challenging. What did you learn from those?
Yeah, so early in my career, I raised and closed a fund, had some partners there. I think at the end of the day, I learned you've got to be on the same page with your partners. And that sounds so pedantic, or that sounds so hallmark. But I'm an Eagle Scout. I was a Scout Master most recently, a Cub Master before that. The Venn diagram of private equity professionals and Eagle Scouts, let alone Scout Masters, probably is pretty limited. I don't know statistically, but I'd love to know. But there's a way to behave with business and with your partners and with your lenders that I just want to subscribe to it. And it's, when I talked about respect, I talked about mostly the management teams, but it's respect for your lenders. It's respect for your third parties, your accountants and your lawyers. Yeah, they work for you, but you can treat them with dignity and respect. And your lenders the same way. If there's problems, let's talk it through. I won't use names, but I've been at other firms where you'd go to DEFCON 5 immediately and get lawyers on the call versus calling the lender and say, hey, we have a problem. It was immediately let's lawyer up and fight, as opposed to pick up the phone and let's have a conversation. So we just saw things differently on a structural basis, on a to be blunt, a kind of a cultural basis. So I learned my lesson there.
Stenning, can I follow up that?
Yeah.
Because presumably you would have gone into the partnership thinking there was culture fit. So you probably, nobody partners with somebody that they don't feel like that there's a cultural fit there. So you probably overlooked something or didn't see something. As you reflect back, what do you think you missed?
Proper due diligence on past cultural differences. So,
so it was a diligence miss.
It was
on the partner.
Yes, it was a diligence miss on thinking that I was going to have a different outcome than others had. That was a diligence miss. That was a diligence.
So there was a track record of broken partnerships with this person.
Yes.
That you might have found.
I found, but I discounted it.
Okay.
So don't think instead of a podcast on private equity, it's on like marriage and dating advice. Don't think you can change people. So I didn't think I was going to change people. I thought I'd just have a different outcome. And then I moved to a different partnership, and that partnership culturally was a much better fit. My partner there was a good guy. It was just we were in different parts of our careers. Where I still do today. I think I have a ton of energy, a ton of gusto, a ton of desire to create success and create success with not only my employees but my management teams. I'm really looking forward to the day where I can present 6-7-figure checks to my management teams when we do exit. And my second partnership, he was just at a different part of his career. He was a little bit more relaxed and a little less driven. And I think to have a good partnership, you both have to be at the right part of that career. And that's not an age thing necessarily. That's a desire thing. That's is this a 20-hour-a-week job for you or a 60-hour-a-week job for you? And that seems like a simple answer, but unless you get an honest response, you're going to have a problem ultimately with a partnership.
It's a great question to ask.
I mean,
to kind of quantify somebody's level of energy and level of commitment to a project.
Yeah, and it's I don't know necessarily, Will, where you can get that from, whether or not that's just a desire, whether or not that's a personal balance sheet, whether or not that's a personality. I don't necessarily know how you get there. I have earlier in my career, and I think we've all been part of those companies and or organizations that give you those 3-hour personality tests. I'm not saying you do that because I think those kind of like lie detector tests, they can either be faked. But ultimately, unfortunately, with partnerships, you're not really going to know until you're in it. Because everyone, right, just like actually to go back to the same mantra, right, when you're dating, right, everyone pretends to not have issues or they're gonna get along with X, Y, and Z until they don't have to anymore. So
you've had partnerships in different formats. You had partnership when you founded an actual fund, which you did. And then you had a partnership, you were a 50-50 sponsor with someone as an independent sponsor, but you were 50-50 with someone. So you had a partner at a holdco level, deal by deal model. And then more recently, we know because we're participating in an upcoming Evolution deal where you have you're co-sponsoring it. So you have a partner on that deal, but that's only on that deal. He's not your partner at Evolution, but Evolution is partnering with another firm for one deal. So how are the dynamics different when you have partners in different ways, and in particular at the sponsor level versus the deal level?
I think, so at the deal level, I think both of us are creating and maintaining optionality. And Nicholas, I think ultimately, if it works really well, obviously you're referring to Chris, and Chris and I have known each other going back to that firm in Miami that used to stand for Harvard Investment Group. So Chris and I have known each other for going on 20 years now, 22 to be specific. So I think there's a known entity there. And I think we both see things very similarly. But both of us aren't ready to go back in a kind of that formal 50-50, let's be under one umbrella forever commitment. And this creates an opportunity for us to kind of bring the best of both worlds. On that, we're bringing one of the Evolution team members that knows healthcare really well. Chris knows healthcare. I don't. So I have resources that Evolution can bring to bear to that, as well as subject matter expertise. So I think there's a symbiotic relationship there. But ultimately, right, that's still Chris's lead, Chris's deal, and we're going to help out. But the interesting thing, Nicholas, is if that works out well, which we will know, X months and certainly years from now, we can do that forever. We can do that on every deal. So the optionality here is second to none, and you can do that as an independent sponsor, which is great.
versus if you have a 50-50 partner at the holdco level. So if you had a 50% partner at Evolution Strategy, you're building that firm together and you're wedded at that point.
Yeah, that was the earlier comment. I'd done 4 deals. My partner had done 0, and it's tough to do math when it's 100 and 0.
You mentioned earlier that you were a different part of your careers, and that I thought was interesting, because one thing that Will and I discuss sometimes, and we have a third partner in Minds Capital as well, is that we're all, give or take, the same age, middle-aged men. And so we have no age diversification. And so we have no one who's 15, 20 years older, who's been there and done it before, has the gray hairs and the gravitas of age and experience. We also don't have anyone who's 10 or 15 years younger, who has maybe fewer family commitments and less adversity to doing all-nighters if that was ever necessary. So could there be a benefit to having partners that are in different parts of their careers and lives?
I think I balance that out with my team members, right? I've got 2 team members, 2.5 team members really, that are in different parts of their career, and they bring honestly different perspectives to it. Similar skill sets. And I say similar, not different, because, right, I grew up in private equity. I grew up doing the all-nighters. I grew up getting yelled at by very stern individuals throughout my career. So I've done the trial by fire. I've done the Excel sheets and why, cell C54 on tab 4 refs out, and you got to figure it out for hours. And the pitch books and the NDAs and reading every line of a SIM, all that stuff. But there's team members that do that now. But this is an apprenticeship business, Nicholas. So I think I have to teach that craft. Some of it's attitude, because what we do isn't necessarily rocket science. It's just it's wisdom mixed with experience, and you only get that from years of experience, because they're very smart people that I work with and ultimately on the team. And they're younger. Do they eventually take over Evolution? I hope so. Right? It's called Evolution Strategy. It's not called Schueppert Capital. So is there a succession plan? I certainly believe there is, and I believe they certainly hope there is. So you can create a succession plan even if you don't have a traditional fund. I think once you develop an independent sponsor with a brand and a portfolio and a track record, there is some sort of institutional value there, even if it's not a formal fund with a fancy office on Park Avenue. But I think if you want to partner with folks that's, Chris and I are almost the very similar ages, anyway. I think you can find partners to do that. You can find co-investment partners to do that. But you can also build a team. There's some independent sponsors that I really respect that build far more of an institution. They're still an independent sponsor, but at that point, they're almost just what I'd say deal by deal. And I know people kind of trade those names back and forth. But, they've got a team of 10 or 12 people. That's a lot of infrastructure to support. And they have a broader portfolio to support that. They look like a traditional fund, but they're just structured independently. I think I like that more so than a traditional fund, as we discussed. But there's different ways to skin the cat. So I don't know if I'm answering your question.
Let me just revisit that partnership you have with Chris, which is a deal that Minds Capital is excited to participate in. Mm-hmm. So this is a deal where you decided to partner, where you have resources at Evolution Strategy, and you're allocating some of those resources towards that deal to support that deal and support Chris in the upcoming operational phase of that deal.
Yes.
And you're doing all of that in exchange to becoming a partner within the GP mix.
Yes.
Do you see this as something that makes Evolution more scalable, that you can get more deals done without having to source them and lead them yourself?
I didn't think of it that way, only because Chris and I have looked at a number of deals over the years, and this is one that we hope to get to the finish line. I didn't think about it, quote unquote, strategically like that, but certainly there is a point where you either need to bring in additional kind of full-time resources to scale, or you just need to admit you can't do more. I think with 5 portfolio companies, I'm chairman of all 5. I'm heavily active in all 5. But that's still very manageable right now because they're all at different stages of their, no pun intended, evolution. You can't do. It would be very difficult to do multiple platform deals at the same time, just like it would be very difficult to sell multiple platform deals at the same time But if you have one here or there that needs an acquisition, needs some new staffing, is dealing with some legal work and all that stuff, I'm able to shift my time and my bandwidth accordingly, and I haven't yet had a conflict. But that's also because, we don't have 10 different portfolio companies at this point. But I think, Nicholas, the interesting answer to your question there is I think about that investment, right? Chris has the lead. One of my partners, Heather, would have the expertise lead and serve on the board. And then I've got Sean and Ken working on kind of the more, what I'll call that VP associate level work. So as I look at it, it's under evolution, but it's not, to be blunt, Nicholas, it won't be much of my time because it'll be 3 of our other folks' time. So I don't think of it as consuming my bandwidth because I don't have the expertise to lend to that. But that is, I guess, to your point, that is a way to scale. But if it was going to be on my shoulders, if it was squarely in my wheelhouse, I'd probably have a tougher time saying that's easy to add to the portfolio because we just added a company and my days are still pretty busy with kind of current work. So that is a good point, but I don't think of it as scaling because I can't scale myself at this point, but my team is scaling with that investment.
This whole co-sponsoring of this deal has been enabled because you have a team.
Yes.
So that's proof in point right there. Another nuance about Evolution Strategy Partners is that you have an advisory board. And I believe you interact with them on a weekly basis. Can you tell us more about that?
Sure. I think advisory boards, many of the advisory boards you see are generally from younger independent sponsors. And to go back to that age thing, I will say rather comically, one of my investors who does do independent sponsor deals and has invested in one of my deals made a comment, and I think it was supposed to be a compliment, but I'll just leave it out there. They said, "You're older than our typical independent sponsor." And I didn't know if I was supposed to take that as a compliment or what. But where I'm going with that is I think younger independent sponsors without a 20-year track record or the resume that's been at firms X, Y, and Z through their careers, I think LPs are a little more reticent to say, okay, this person can go on their own. So generally advisory boards are that, to use your words, Nicholas, the kind of the gray-haired people that bring some gravitas to what otherwise is a younger or more experienced independent sponsor. I personally don't think I'm at that point because my advisory board is either my age or only slightly older. And of note, what they bring to the table is not necessarily a Rolodex that I don't already have. But I think at some point, every leadership position is lonely, right? The CEOs and especially the founders of the businesses that we've invested in, as I said, for years, I'm not saying they're looking for a friend, but it's the first time where they've had a true opportunity to just talk with someone where they don't have to have every answer. The CEO job is a lonely job, especially a CEO founder job. The advisory board for me, it's folks that I trust, it's folks that I respect. Some of it is almost just a discipline for me. So I do, Nicholas, to your point, as we discussed, I do send an email every week, almost every week. I miss some sometimes if I'm traveling or I'm particularly busy, but every week, and I go through the whole portfolio, and I go through the entire pipeline, and I just say it like it is. It usually involves language that wouldn't be appropriate for a public broadcast because transparency. Colorful, I didn't add to my earlier answers, Will, but if you read years of my advisory board updates, you would see they are colorful, but they are also dreadfully honest and dreadfully transparent. I say it like it is. And sometimes I'm looking for, some advice. Sometimes I'm looking for attaboy, keep it up. It'll get better. Perspective is a great word we didn't use earlier, but that's another word that I think is appropriate for any successful independent sponsor, is just perspective. So sometimes they're helpful. They've said, "Oh, talk to this person," or we get comps on other lender deals or other equity sponsors or what have you. So Having someone to bounce ideas off of, I think, is invaluable. Even if they don't have a formal role, you don't need to say, okay, I need to go to a vote, right? This is an advisory board where I have to get their approval to do a deal. That's not it at all. But an advisory board to give you, quite frankly, advice, right? That's technically what an advisory board ultimately means, and it should be. So it's not a legal requirement. And I've never had, quote, professional coaching or a therapist or anything like that. But having a team that you can either share with and they can either proactively or reactively bounce ideas off, I think is invaluable. And I think every independent sponsor should do that. The larger independent sponsors that I mentioned that have 12 or 13 people, right? They have that internally. The smaller independent sponsors that have, 1 to 4 people, where are they getting their sense of perspective, right? Because I certainly am never, certainly not always the smartest person in the room, and I always love a little perspective, even if it's just as simple as just writing it out. And then when you write it out, you're like, why didn't I think of X? Or, well, this is so obvious, I should have done Y. So it is very valuable for me, even if it's not a legal structure or a legal requirement.
Stenning, back to the comment that you heard about your age, didn't you also hear either from that individual or others that of LPs being burned by younger sponsors? In other words, something about their inexperience was cited as the source for their failing?
Yeah, and for me, that's interesting. Older independents, well, not older. In my opinion, older independent sponsors want an LP that's going to support them and get out of the way. And I think a bunch of the LPs have gotten burned by more inexperienced independent sponsors that are kind of looking more for a job or looking for an option. In my opinion, as we discussed, I think the greatest option is, literally negative dollars into a deal, like traditional private equity. But nonetheless, the industry still has a little bit of a stigma, where younger independent sponsors, or at least earlier independent sponsors, regardless of their age, until they have a deal or two, ultimately are trying to really create a job for themselves. And that, in my opinion, is not the alignment we talked about earlier in the show. But to get to your question, either younger or more experienced, I don't necessarily know which, there's been, I know specifically because one of the LPs in my deal had this clause in our documents that they could technically fire me as the sponsor if I didn't effectively show up for work. And I laughed at the concept. I was like, not only am I going to show up for work, I'm worried you're not going to let me do my job. So you have this inherent conflict with, I'm going to do everything to do my job. By the way, because my job is 20 to 50% of my own money, right? To go back, Nicholas, I'm better off making money for myself than I am for you. So I have all the incentive I need, let alone here and here, to make this succeed. But regardless, if you just talk about economically, I'm more incented than you are to make money on this deal. But let's take that aside. Some LPs have been burned by independent sponsors that get either the closing fee or have their documents and they've got their promote, and they kind of laugh and say, okay, great, call me in 5 years and we'll see how it works out. That may work for them. And I know there's a few LPs out there that kind of look at any sponsors as kind of deal flow, and they see that as a necessary evil is the wrong word, but a necessary tool to just see deal flow in the lower to middle market. And they consider that a cost to get that access to deal flow. Myself, I can only speak for myself and a few others that I know. There's a lot of independent sponsors out there that says, we're not deal flow. We are here to run these portfolio companies the best we can. And as a result, I'm not saying get out of our way because you wrote a large check. You have all the rights you do, but you have those rights either from board seats and or from negative controls in the LLC agreement, et cetera. You have the controls you need. But it's a weird inherent conflict between I'm scared you're not going to do my job, and I'm scared you're not going to let me do my job. It's this weird mix, and there's a little dance between a new LP and a GP. I think that probably happens every time, be it at McGuire Woods or 3 months into a deal.
And Stenning, just to clarify a point on the alignment, which we've now returned to again. And as you pointed out, it's one of your favorite characteristics, or maybe your favorite characteristic in the independent sponsor model. But so I am clear, you've created this great alignment because of the amount of skin in the game that you at Evolution has, but it's not necessarily inherent to the model, as you just pointed out. There can be so it's not necessarily independent sponsor versus private equity funds or traditional private equity. It's how Stenning runs Evolution.
Correct.
So it enables this. It enables this alignment that you guys have, but it's really more of a feature of you guys than it is necessarily independent sponsorship broadly.
Yes, but
fair,
fair-ish. But I think the size of deals that independent sponsors usually chase allows us as independent sponsors to write enough of a check to make a difference. To be blunt, if I did a $100 million deal, I could not be 20% of the cap stack. I am balance sheet rich, very cash poor. So there is a limit to the math on larger numbers. So yeah, if I was writing a $100 million check, I could no longer say Evolution is 20% of the cap stack. There is a limit to math. So it does, Will, to your point, spot on. It does enable that alignment. But to be blunt, right? If you're a younger or more experienced independent sponsor that hasn't maybe saved as much as I have over the years and just constantly reinvested in everything from your old private equity deals to the stock market, you may not be able to write a 6-figure check for your first deal. I get it. But going forward, you certainly should have the opportunity to.
Stenning, you said there that you're balance sheet rich but cash poor. The case of many entrepreneurs, of course. Have you ever looked into these alternative liquidity vehicles that are starting to pop up in our space, where they effectively give you a loan against your illiquid private assets, which in your case are marked up very nicely?
I've thought about it. It's a risk return profile that's just different. As much as I spent many years arguing as much leverage as possible, I sleep really well at night with our portfolio. In one case that has literally no senior secured debt. In other cases has 1 to 1.5 times senior leverage. Even our landscaper is sitting on 2-ish times leverage. So re-levering your balance sheet to create a little liquidity, I understand that, but it just changes your risk return profile, Nicholas.
But let me elaborate, since we haven't brought up the topic here before. But so there are some alternative credit firms that exist, and you would be like the ideal client because you personally, or Evolution at the Evolution level, is sitting on 5 portfolio companies. So it's fairly diversified. You're well in the money. You have a line of sight on a good amount of carry from multiple sources. And so they can value that. And then they can give you a loan against that value. And that money, in turn, you can either cash out for personal purposes so that you don't feel temptation to sell prematurely, or you can use that cash to reinvest it into your next platform so you can continue to be 20 to 50% of the capital, even though you haven't had big liquidity events within your portfolio yet. So does this concept make sense to you? And
yeah, Nicholas, it totally makes sense. It's no different than, however, I could do that and refinance my home, right? I'm not going to ask you personally how much of a mortgage is on yours, but I can tell you my mortgage on my house here is now down to less than 6 figures. I could go refinance my home and only have, a leverage against a fixed asset at probably, a 4 to 5% rate versus an 8 to 10% rate. So if I wanted to create additional liquidity, I could from that.
Right.
I mean, it's interesting. We had the same conversation back when I was at GTCR Golder Rauner, great firm out of Chicago, Bruce Rauner, et cetera. I've got plenty of stories about Bruce and cigars and all sorts of stuff there. But anyway, at the pre-MBA level, we were trying to get more money into the deals, and we were talking to one of our banks at the time, and they could lever our co-invest. And ultimately, I talked to some smart people, and they're like, if you really want that leverage, go lever your house. And at the time I was pre-MBA, I was like, I don't have a house. And they're like, okay, well, there's got to be friends that you can borrow money from at either a lower rate or with fewer covenants and restrictions. So Nicholas, what you're talking about makes total sense. I'm at the point where, look, as I said, I fly Southwest, I stay at Holiday Inn, I drive a used car. If I put more money in my pocket today, it's not going to change my life. I'd rather just sleep at night and say these investments, I don't have incentive. I think if you do create a loan against a future cash, I think ironically you have more incentive to cash out, because every day is ticking at 8-10%. I don't know what those prices are. So in a bizarre way, I think actually you create some misalignment because your investors aren't necessarily cashed out. And if I say, hey guys, I monetized 100% of the carry on portfolio company X, they're going to be like, well, shoot, Stenning, we didn't. Why didn't we get that opportunity? Whereas that's totally different than our approach on Allied Underground. Allied Underground, I mentioned earlier, we had cash on the balance sheet. We paid off 100% of the senior debt. We offered a share tender to all shares. And obviously you guys know enough about law and LLC agreements, right? Every share needs to be treated equally. We offered the exact same price to all shares, and people could cash out anywhere from 0 to 100%. And on that one, Nicholas, talk about alignment. I took 100, I and my employees that had carry, obviously, as well. 100% of the Evolution employees took 100% of our carry and rollover. We didn't take a dime. So there was a case we could have taken some chips off the table along with our investors. And we said, no, we believe in the business. Sometimes the hardest place to find capital to put to work is the ultimate challenge. And if you can bet in yourself, what better bet?
Stenning, I think that's a perfect place to conclude. What rich conversation. Thank you very much for coming on and sharing what you've built at Evolution. We will put a link to the firm. We'll put a link to your LinkedIn in the show notes, and people can reach out if they have questions or a deal or what have you.
Wonderful. Looking forward to it. Thank you both.
Stenning Schueppert, thank you very much for joining us on the Minds Capital podcast.
Thanks so much.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.